Aaron, this is Abi. There's a couple of questions on the chat. I don't know if you've been following them, or I could just bring them up for perhaps for the benefit of people who are on the phone. So I'm going to go from newest to the earliest. So one of the questions was, aside from utility bill history repayment, was there no other mortgage consent or lender review before a person qualified for the program?
Yeah, we didn't have to deal with mortgage consent because we were not doing PACE financing, so we were not taking a priority lien position to the existing mortgage lender, so we were subordinate to them. We were actually, and Craft 3 wanted to do this. It turned out to be not helpful in the end, but originally, out of kind of an abundance of caution, they were actually filing what we called a blind lien position on the home. So they were in a subordinate position, either second or third behind the primary mortgage, a HELOC. They didn't know. The point is they didn't even know where they were going to be in order of priority, but they did file a lien and essentially underwrote a quote unquote mortgage product initially. But then we learned fairly quickly again after the financial crisis, which was driven by poor mortgage lending practices, that actually all the potential secondary market investors said to us, it's actually a liability, not an asset for you to have these kind of mortgage instruments that are in a blind position. So we stopped doing that, and no, we did not have to deal with lender consent or any of those kind of PACE financing related issues.
Thanks, Aaron. So how far back did you go when you were screening for underwriting criteria? Was it 3 or 4 years or longer or fewer?
That's a good question. I'd have to actually go back and look definitively what that was. I want to say it was 12 months or 24 months, and there were some challenges again. So we worked with 3 different utility companies, Northwest Natural, which was the gas company, and then 2 electric utilities, Pacific Power and PGE, Portland General Electric. I knew very little about the regulated utility sector, but I found out quickly they all have different billing systems. So I don't know what anyone's personal experience is here, but if you've moved around into different homes, sometimes your utility bill goes with the address, for example, and sometimes it goes with the individual human being, right? So that was a tremendous challenge in things like evaluating utility payment history for and I don't remember which one, I think it was Pacific Power. Their billing system was architected, again, probably in the early 90s, late 80s, using some obscure language, coding language like COBOL or whatever. Like these systems, it's not to be underestimated, the kind of the legacy issues in the regulated utility sector and the underinvestment in their IT systems based on pressure to have rates stay low, right? Like they have a hard time getting authorization for modernization of their IT systems. Anyways, point is, we had some difficulties in that. So I remember it being shorter than longer, where we would have loved to have 3, 4, 5, this long history of utility payment performance, and we weren't able to attain that, but it was somewhere in the order of 12 to 24 months.
Thanks, Aaron. I'm hoping, I'll put a camera on here so you can see me. So Matt Green, I work at the CRD, and I'm hoping to ask you about the contractor list in specific terms. Like, how did you create that qualified list of contractors? How did you administer it? Was everybody able to bid on the same project, or how did it work?
Sure, yeah, no, great questions. So we were fortunate enough to have a self-organized cohort of home performance contractors, quote unquote, in Oregon. They were called the Home Performance Guild, and they were a chapter of the Building Performance Institute, which was a national organization in the US that to my knowledge doesn't have a direct Canadian equivalent, but maybe could. And so we were able to rely on that group. They were relatively small when we started the program in 2008. And so we relied on that self-organized cohort, which was, I think at the time was like 12 contractors, something like that, which seemed like enough to do 500 homes. From there, by the time it was 2014, 2015, we had something like 55 different companies that were qualified contractors within our program. We required that BPI certification. So you could grab any certification you wanted, I guess, as long as a program administrator or a municipality, you made a determination that it was rigorous enough and it robust enough and actually meant something. But I would suggest grabbing onto some kind of third-party certification that exists in the marketplace and just telling contractors they have to meet that minimum requirement, which is what we did. We got objections from contractors that maybe weren't already certified that wanted, to get on the gravy train of the stimulus dollars, and to which we said, that's fine, but we're not going to compromise the integrity of our offering. And then therefore we actually did support training for them to attain the certification, right? So we supported the supply chain with money, with training, with workforce support, so that contractors could meet the standards that we imposed. From a contractor management perspective, we again leaned on that organization. We funded the executive director of that, like a new position, because they were had voluntary governance, right? Because they were just a group of contractors that self-organized, and so they would rotate who's the board chair, who's the secretary, and we actually gave them a staff grant to have an executive director so they could be better organized. That executive director could speak to us as a program with a single voice representing 55 contractors. And we asked them and essentially gave them an opportunity to self-regulate as an industry, and conveyed to them the importance of consumer confidence, quality assurance, consumer protections for a program like ours that was using public dollars. They accepted that, and we essentially came up with some criteria. One was just like a 3 strikes and you're out policy, where if we found, 3 instances of fraudulent behavior, of course, right, like misrepresenting an invoice or price gouging, things like that, then they would be kicked out of the program.
So I want to cut in for 1 second. That's great information. The future webinar that we will be having will be around the operations side of it, so that contractor qualification and sort of that journey mapping with your customer. So let's try and stay a little bit focused, just because of a limited time, to the actual financing pieces. So we have a question from Robin Webb from Victoria. Robin, do you want to unmute yourself and ask that one, or?
Hey everyone, I was just curious about how you established the relationship with the utilities and got them on board, and was the loan loss guarantee important for them initially to participate?
Sure. Well, so that's a great question. The answer is largely by force, political pressure, which was, I guess, somewhat the result of, I don't know how many of you remember a wonderful company called Enron, or paid attention to such wonderful corporate behavior that they had. But essentially they did some unethical things in the early 2000s during the Bush-Cheney years. Portland General Electric Company was acquired by Enron in the late 90s, and it got wrapped up in that entire crisis. And so that basically created a political environment where both the state of Oregon and the city of Portland threatened to municipalize the utility companies. And so they had that threat to wield, to basically say to them, you're going to do this, we want to do this, and you're going to use your billing system. So political pressure ultimately was why they were forced to the table. Once they were at the table, they were fairly good actors. What they did want, the loan loss reserve didn't matter to them because we weren't using their capital for the loan products. What they did require, and what we did do, was use some of our grant money to pay for the upgrades and modifications to their billing systems that we needed. They suggested that they would be unable to gain regulatory approval for those types of costs and upgrades broadly from their ratepayer base, because not all ratepayers would benefit, and blah, blah, blah. And so we just took care of those objections with money and said, fine, we'll pay for it, which ended up being, hundreds of thousands of dollars. So it wasn't insignificant, but when we were trying to move you know, 20, 30, 40 million dollars, it seemed tolerable.
So they, in British Columbia, we also had the province step in and ask both FortisBC, our natural gas provider, as well as the electric utility, to provide an on-bill financing pilot in a couple of different communities. Obviously, it was a pilot, and obviously there was very little uptake and all the rest of that. But they would have had to address some of their, or at least face some of their billing system woes in doing that pilot. And I think that's also an example of where Aaron says that you know, it may be that the government steps in to provide some of that encouragement. I would say, and maybe we'll go and ask John over at Efficiency One in Nova Scotia, and if anyone from BC Hydro is on the line today, to maybe give a little bit of a perspective from the utility. But I would suggest that, you know, now is a time where energy affordability is kind of prescient, and that utilities are being asked to step up and help out with providing relief to homeowners who are struggling and have high energy cost burdens or have been adversely affected by COVID-19. So I think this is a time where utilities will be great partners. Certainly in British Columbia, we already have a really great partnership with BC Hydro. Not every province enjoys, or not every city enjoys the same level of relationship. But John, do you have anything to say from Efficiency One? I mean, you're a little bit different because you're a conservation utility, but can you give a perspective on what you see the utilities take being on this?
Yeah, so I think we're in a bit of a different situation here because you know, Nova Scotia Power funds us, so it's a very unique arrangement that we have with the utility here. We apply to our utility board for funding, and we essentially sell energy efficiency back to Nova Scotia Power, so we can roll out our efficiency programs at a lower cost than they produce their energy for. And so that's the whole concept of the program, is that we can create energy efficiency at 3 cents a kilowatt hour, and they produce it at 7 cents a kilowatt hour. So for the ratepayer, there's a benefit in our programs over them producing the energy. So that's the funding model we've got, which is very unique. You know, as far as what's going on today, Nova Scotia Power came out very early in the game here and said that they were not going to be reducing utility rates during COVID. They were very clear on that. So, you know, they aren't doing that to benefit anybody. They do have a whole separate mechanism they use for people who can't afford to pay their bills, so to speak. So the people who do need help paying the utility bills will get support through a different mechanism at Nova Scotia Power. So you know, I struggle with how they would actually just lower their rates during COVID.
What about on-bill financing, though? Do you think that they'd be receptive to an approach from the City of Halifax or others to look at on-bill financing as opposed to property assessed? I mean, you do have enabling authority there in Nova Scotia, unlike a lot of provinces, but do you think that the utility would see some nice co-branding and some nice benefits in providing on-bill, or they see it as an administrative nightmare?
They actually do on-bill financing because they have a heat pump program that they endorse, and it's on-bill, and so they hire the contractors to go install the heat pump on one of their customers' homes or residences, and then that's just an on-bill financing mechanism they use for that. So they've already got it going.
Okay.
Yeah.
Great. Let's move on to another. What have you got, Abby?
Aaron, this is Abby. So this is a question that came up a couple of times in the comments. What were the default rates on the loans, and how does that compare with that, you know, other asset default rates?
Yeah, so we could click through on Craft 3, publish some of that information, but it was less than 1%. It essentially mirrored very closely the actual utility defaults and delinquencies on the power portion of the bill, which again was our theory and approach at that for that financial product. So how that compares to other types of lending products. I also remember looking in 2009, the Federal Reserve, I think it is, publishes like average interest rates by loan product or something like that. So credit cards versus mortgages versus auto loans, all that stuff. And I had benchmarked, you know, kind of worst case scenario. What is the greatest rate of defaults on the riskiest type of loan, which is which is a credit card, right? A credit card is the most unsecured, most frivolously used financial product out there, and often is going to have the greatest rate of losses or defaults. Even in 2009, after the financial crisis, I think it was like 9% was the default and loss rates for credit cards. So why that was important to me when we approached lenders with our 10% loan loss reserve was to say, like, listen, you guys can tell me the sky's falling because I know you love to do that. You can tell me all the reasons why you won't do this because you love to do that, right? Like, and again, I learned to at least respect and appreciate the perspective of the regulated financial sector, which is they are highly regulated and highly rules oriented, and they don't often go outside of the box, right? They're not outside the box thinkers, and frankly, they're very afraid to move outside of clear regulatory parameters because they get in trouble. But anyways, as a reference point, right? So 10% was very helpful, and yeah, our on-bill was only 1%, and I think frankly, Umpqua also found that really one of the key drivers of losses and defaults on any financial product is going to be customer happiness. Like, are they happy with what they got? Do they like the car that they bought? They're going to pay for the car loan. If they bought a lemon, right? Like people that bought used cars that aren't good cars, there is a direct correlation between the performance of them paying off the loan, right? So that was where it was interesting when we engaged Umpqua Bank, the regional multi-state bank, to participate in our program, and they quickly saw that they were willing to do things that they weren't previously doing in terms of pricing their products for energy efficiency because of the perceived customer experience of our program, right? That we had high levels of customer satisfaction. We would survey our participants. We had the highly qualified certified contractor network, and all those things together affected the rates and terms that they needed to see.
So that loan loss reserve seems like it's pretty key to getting off the ground, at least initially, before you were able to show predictability to Umpqua. So remind us who did that loan loss reserve come from? How was that financed?
So all of our money was grant money, right? So from the American Recovery Reinvestment Act, the first $25 million that we used was all federal money, economic stimulus money. And so we decided to take part of that and actually capitalize the loan portfolio. So we pushed $4 million over to Craft 3 to manage and repay us, but really to use as the principal balance of the financial products. And then we carved out the 10% loan loss reserve as well, which of most by now has been either recovered or utilized. So we also structured our loan loss reserve agreements to reset after 5 years because of this idea that once we establish predictability, financial institutions could either then manage that risk because it was now predictable risk, right? And they do this all the time. I mean, financial institutions are required to self-fund from their own capital and equity on their balance sheet a loan loss reserve for every type of financial product they offer, right? And it's going to be higher for credit cards than it is for mortgages because of the security profile. So we basically wrote those to say, you know, as fast as I could, but typically, certainly after 5 years, we would agree that the loan loss reserve would reset to a multiple of actual losses over that 5-year period. And essentially, we were making a bet that actual losses would be 1% or less, and that if I put 10 cents on the dollar on the table, and at 5 times actual losses, if they did come in at 1%, then we were going to get 5 cents on the dollar back, right, after 5 years, which we did, and we achieved, and that helped the organization fund itself forward.